Matthew Bell here. Today I want to talk about some different conceptions of retirement. Now, this is going to be somewhat artistic. So what I mean by that is impressionistic. It's going to basically be very, very kind of general. There's going to be a lot of stuff that people might go, well, wait a minute, there's going to be some specifics I'm glossing over. So let me just suggest some caveats. I'm going to do 7 different conceptions of what it is to go into retirement. 7 different conceptions of how you can actually fund your retirement. Caveats. First caveat is there's probably an indefinite number of ways that you can go into retirement. There's no question about it. You could have any number of different passive income generating assets. Somebody might have real estate investments. They might be living off of rent money that they're receiving. Somebody might own a franchise or some other kind of a business, and they might be living off of the profits of that. Person might invest in dividend paying companies, stocks that have dividends, and they might be living off of their dividends. I mean, that there's any number of different conceptions for how to actually retire. But what I'm going to be focused on here in this video is going to be a conception that I've spoken about elsewhere, and it's really known as the three-legged stool. Okay, and when this conception was in vogue, the 3 legs of the retirement stool were essentially: number 1, an employer pension; number 2, government Social Security; and number 3, your private retirement savings. So based on that 3-legged stool conception, okay, I'm going to arrive at 7 different concepts for what retirement might look like, and I hope in doing that we're going to have at least the ability to spark a discussion or to start thinking about what would be required for your retirement. What's the value? I think the operative saying is, and I love sayings, I think that they can help you to sort of orient your thinking in a particular direction, and they can do it fairly quickly. But the saying that I'm thinking of in going through this video is basically: the person that aims at nothing invariably hits his or her mark. And so the idea isn't that you're going to have one ironclad conception of retirement, and that is just going to persist, and you're going to carry that through from the starting line to the finish line. It's simply that if you are aiming at nothing, you're going to hit your mark. Or what if you hit your mark? That's scary. So the idea that I'm trying to press here is that you should at least have some idea of what your retirement is going to look like, and that's going to help to shape the plans that you put into place, and hopefully it's at least going to make you better off than you would have been without that kind of conception. So without further ado, let me go into the 7 different conceptions of retirement as I'm seeing it. Now, first of all, let me say, besides the caveats that I just named, think about again the 3-legged stool: employer pension, Social Security, and private savings. Each of these is going to have its own history, and the history of employer pensions is very interesting. The history of Social Security is interesting. The history of the 401k is interesting. I am not going to be bound today by each of these histories. What I'm really concerned with is the way people think about retirement. So I'm mostly concerned with a person's conception of retirement, and a conception that a person has could be loosely connected to history. It could be tightly connected to history. Might have, you know what I mean? So the point that I'm making is that somebody's conception of retirement may or may not be accurate, an accurate representation of the actual history. So let's just think about the very first conception of retirement that I'm thinking of here is going to be the employer will take care of me conception. This is going to be the pension, basically, the pension conception of retirement. Now, another word or another phrase for the pension is the defined benefit plan. Now, to start off, I'm basically going to say this. For any retirement plan, there's really 3 components. Really 3. The first component is the contribution. Okay, that's what you pay in to the retirement plan, the contribution. The second is going to be the earnings. That is to say, for any contribution you make, that contribution is going to be invested in some kind of vehicle. You're going to put it in something. It could be a CD or a savings account where you're basically making almost no interest at all. But whatever vehicle you put it in, it's at least possible that there could be earnings, right? That's the idea, is that you're going to have to save. The whole point of retirement is that you're going to put away money now for use later. So you're going to contribute, you're going to put in money, it's going to hopefully earn something, and then the third piece is going to be the benefit or the distributions that you're able to take from that retirement plan. Okay. Now, when we think about a pension plan, if it is called a defined benefit plan, that basically means that of the three pieces, contribution, earnings, and benefit, defined benefit plan is going to be a plan that actually has some determination and even a guarantee on what comes out, the benefit. Now, when I say guarantee, and I put the scare quotes on there, here's what I mean, is that the benefit is only as good, or the guarantee is only as good as the person who makes it, or the company that makes it. So the guarantee is only as good as the guarantor. So there are companies in the past that have said, here's your pension, and then the company collapses or is unable to pay the pension. And so that guarantee didn't turn out to be worth very much. Okay. But the idea behind a pension plan or a defined benefit plan is that the thing that's guaranteed is what comes out. So you've got what goes into the retirement plan, you've got the earnings, and then what comes out. Okay, so in a defined benefit plan, what comes out is, at least in principle, okay, in theory anyway, is guaranteed. Now, this conception of retirement may or may not apply. A number of employers today, fewer and fewer in fact, are offering pension plans. So you don't, in this conception, you're putting all of your retirement faith essentially in the employer. You're saying essentially, I'm going to trust them to take care of me in retirement. And in the past, this was not an ill-founded faith to have. The pension was basically calculated usually on three or so different factors. One would be your age. One would be the amount of service that you had with the company. So, for example, if you had 10 years or 5 years or 25 years or 50 years with the company, you would have a different payout. And the third factor was going to be the amount of money that you earn. And that would be a function of your job position, presumably in the amount of time you had with the company. So, but there are fewer and fewer companies who are offering pensions. So if your plan is to count on your employer taking care of you in retirement, the thing would be, make sure you understand what your benefit package is, make sure you understand what you need to do to qualify, if there even is a pension, and you just need to make sure that you understand what the employer is actually offering you. Now, the second conception of retirement is going to have to do with that second plank. We said employer pension, Social Security, private saving. So the second person is the person who says the government's going to take care of me, Social Security. And with respect to a Social Security conception of retirement, that might be a person who either has no pension and they have no money put away in retirement. That might be the person who says, you know what, I know that my employer is offering a 401k, but in order for me to contribute to that, I'm going to need to reduce the amount of money I'm taking in my paycheck, and I just can't do it. I have no available money. My budget is so tight, I can't contribute anything to my retirement on my own. And if my employer's not doing it, I'm just going to count on Social Security. Well, a couple of things. First of all, there are a number of people who are fearful that Social Security will not be around, or that it will not be able to deliver on the amount of benefits that it has promised to people. I don't really want to weigh in on that question today. I am not going to weigh in on the politics right now. The only thing I would say is, if you're in the camp of those who think that Social Security will be around and you're counting on it, make sure that you understand all of the political issues that are relevant, right? Because don't just blindly assume. A lot of people have a kind of an ostrich view of their retirement, meaning they're going to put their head in the sand. I know the ostrich probably doesn't really do this, but you get my meaning. They're just going to pretend like they're not going to worry about the issue, and they're just going to assume everything's going to be fine. Very dangerous position to be in. So if you're trusting in the government, then make sure you understand the political issues at play. Make sure that you are voting for those candidates who are going to do what you need them to do, and that kind of thing. I mean, right? You really have to take care of your own retirement in that way if you're trusting on the government. Just a couple of quick numbers for you. Recently, I just did a Google search, and it was, what is the average Social Security benefit? And the top return, the snippet, said that the average monthly Social Security benefit is $1,461. Over the course of a year, $1,461 is about $17,000, $17,500. And so the question is, if you're counting on Social Security, one question you have to ask yourself is that benefit going to be enough? Even if the Social Security benefit is around. From some of the information that is available on the internet, you can find that the Social Security benefit is basically going to be about 40% of your pay now. So if you're making $100,000, we're talking about a Social Security benefit of about $40,000. If you're making $50,000, then your Social Security benefit is going to be around $20,000. If you're making $30,000, your Social Security benefit is going to be around $12,000. Now, I'm not predicting, please, for any actual advice or calculations, you need to check the Social Security Administration. You need to make sure you're paid in the number of credits that's required to get a Social Security benefit in the first place. Talk to financial advisors, talk to plan administrators at your work and so on, your human resource department and others. This video is simply for general, informational, and entertainment purposes only. I am not giving you financial or legal or any other kind of advice. But what I'm saying is, on average, you got to realize what the Social Security benefit is supposed to be for, or is capable of doing, and what it isn't capable of doing. And even if it's around, if it's only providing 40% of the money you're making right now, you've got to ask yourself, is that enough to live on? Maybe it is, maybe it isn't. And so I can't answer that question for you. But the third conception of retirement, so we dealt with employer pension, we dealt with Social Security. So now remember, the third leg of that three-legged stool was private savings, personal retirement saving. Now this can be done in a variety of ways. It could be done with an employer-sponsored plan, 401k. Some people might have a 403b. They might have a 457. I have different videos talking about each of these plans. They might have a traditional IRA, or an individual retirement account, or individual retirement annuity. They might have a Roth IRA. And again, I have videos on these as well. But whatever the vehicle is, this conception of retirement, there are a number of conceptions actually that are going to be based on personal retirement savings. In fact, the way that I'm reckoning it is there's actually 3 different ways. Now, I don't want you to lose count here overall. So we dealt with the employer pension, Social Security, and now I'm literally going to say there are 3 different additional ways that you can reckon how to use your personal retirement savings in retirement. Okay, and let me explain what I mean. Now, to do this, I am going to construct a contrived example here. Let us say that you have $1 million saved for retirement. Now, I'm going to yada yada over taxes and over cost of living and everything, because I just want you to get the kind of simple conception. It's very difficult to talk about retirement planning in any great depth because there are so many variables. There's going to be cost of living, there's inflation, there are taxes and all kinds of things that you might want to factor in. But what I'm going to say is, let's just go with $1 million and let's just yada yada over cost of living, inflation, and a lot of other things. And I know that's not ideal, but let's do it anyway. So one conception of retirement, if you have $1 million saved, is going to be what I'm calling the pile of money option. So if you treat your retirement savings like a pile of money, what does that mean? Well, let's just be really sort of crass. Let's say that you have $1 million saved and you literally put it in a tin can and you bury it in the yard, or you stuff it in your mattress. Every year you pull out $50,000. Let's say you need $50,000 in order to live. How many years can you survive with $1 million in a tin can? 20 years at $50,000 a year. So what am I abstracting away from? I'm abstracting away from cost of living. I'm abstracting away from inflation. I'm pretending like you never need to pay for long-term care costs. Your health coverage doesn't go up, and so on. Lots of things that are probably likely to occur, and I'm pretending like they're not occurring. Just to get you to understand that if you have $1 million saved and you treat it like a pile of money, it's going to run out in 20 years if you need $50,000 a year. Now, that means we've got employer pension, we've got Social Security, and then we have a pile of money way of treating $1 million that you might have saved in retirement. There's another way of thinking about that money, though, and this is the way that a lot of investment folks, a lot of brokerage account or mutual fund managers are going to treat the $1 million, and they're basically going to say something like this. And this is what I'm going to call the interest machine. So if they tell you, look, you've got $1 million, if you can put that $1 million into a vehicle that is producing 5% rate of return every year, then in principle you could take that $1 million And every year you could have 5% interest, which is 50,000. You could draw that return off. You could take that 50,000 that $1 million generates. So every year, $1 million at a 5% rate of return is going to generate 50,000. And so their conception is, if you have $1 million, you could generate 50,000 every year, and if that's what you require to live on, then again, in theory, you could never touch that million. You could leave that principal alone, only take off the 50,000, and you'd be fine indefinitely. Now that is a conception that some people, I think, actually have in retirement, is that they're going to just simply live off the interest of whatever amount that they've accumulated for their retirement. Now there's a couple of difficulties with the things that we've discussed so far. First of all, with respect to drawing it off as a pile of money, think about it this way. In 19 years, if you've got $1 million in a tin can and you've drawn 50,000 out a year, at year 19, how much do you have left in that tin can? $50,000, right? How scary is that? Are you just going to live 1 year? Are you sure you're only going to live 20 years? Let's say you retire at age 67 and you have 20 years worth of income, then you are planning on dying at age 87. Are you sure? Obviously, that's a dicey proposition. So there's some trepidation there. If you put your money and treat it like a pile of money and just draw it down, you're placing your faith in your own longevity, for example, in your calculation of how long you're going to live. Even if you put it in a bank account, and you wouldn't, let's say you put it in 4 or 5 different bank accounts in order to stay below the FDIC insurability threshold, but let's say you have it in the bank or in a CD, and it's earning virtually nothing. It's essentially like a pile of money in that case. So what you're placing your faith in is the fact that you're going to die at a particular time, that money is going to stay fairly well secured. You're not going to lose it to theft or, in the case of a tin can, a flood or a fire or somebody's going to steal it. But in addition to that, you're trusting that your cost of living is not going to go up, you're not going to need long-term care, and all the like of that. Your expenses are going to be somewhat stable over the course of 20 years, right? If you are treating it like an interest machine and you're placing it in some vehicle, whether it's in the market, whether it's a CD, or trusting on an interest rate or on some investment return, then what you're trusting in is the market or the investment return. So what happens in year 15 or year 10 or year 5 if you only return 3%, right? If you have $1 million and it's returning 5% every single year, you are indeed okay as long as you only need to spend 50,000. But what happens if that vehicle only returns 3%? What happens if that investment vehicle returns 0% 1 year? Where are you going to get the 50,000? Well, it's going to have to come out of the principal, which are going to reduce the amount you have invested, which is going to mean that in subsequent years, 5% is not going to generate the amount you need to live on. And that's, again, abstracting away from cost of living and every other kind of factor that we have been considering up to this point. Any one of these strategies, I hope you're getting the picture, any one of these strategies is going to have certain pluses, certain things that are attractive about it, and then certain minuses. Now, the third way of thinking about $1 million that you have saved in retirement is going to be the annuity. And the annuity is essentially a change. You're changing an asset into an income stream. So let's call it asset into income. So if you have $1 million, instead of keeping it in a tin can or keeping it in a savings account and just drawing off 50,000 a year, and instead of keeping it in an investment account and drawing off interest and hoping that you get 5% return every year, the annuity is where you would basically give the $1 million to an insurance company. Usually it's going to be an insurance company that's going to provide an annuity. You're going to give them $1 million. You're going to give it to them. And in exchange, they are going to guarantee you a certain amount of income. So let's just say it's 50,000. You give them $1 million, and they will guarantee you 50,000 a year for the rest of your life. Now, if you live 20 years, you got your $1 million back. If you live 25 years, you get more than your $1 million back. If you live 30 years, etc. Well, some people worry, what if I only live 5 years or 10 years? There are certain ways with an annuity that you can designate a beneficiary. You can make the annuity pay out over a certain period of time. So, for example, you could have it based on your life and then a certain payout guaranteed for 20 years. Your benefit amount does go down, but the benefit of the annuity is that there's this guaranteed amount of lifetime income. Now, some of the deficits, you give up the principal, right? You no longer are the owner of that $1 million. The insurance company owns it. What you have done is exchanged your asset of $1 million for a guaranteed income stream of $50,000 a year, just to pull numbers out of the air, right? Now, a number of people are uneasy about that, but when you think of it, the danger with some of the other strategies is that, number one, with the pile of money, you're going to run out of money or you're going to outlive it. Number two, with the investment strategy, the income machine or the interest machine, that you're not going to get the returns that you've been counting on. So the annuity gives you a kind of a baseline confidence that some of the other plans maybe can't give you. But at the same time, where are you placing your faith? So instead of placing your faith in your longevity, as you are in the pile of money situation, and instead of placing your faith in the market, like you are in the interest machine, you are placing your faith in an insurance company. And so, again, you're giving up the principal. And still in all, with all of these strategies, we're abstracting away from things like cost of living increases. We're assuming that if you secure for yourself a $50,000 a year benefit, that you're not going to need long-term care, that you're not going to experience the effects of inflation and price increases and that kind of a thing, right? So now we've gone over the employer pension, we've gone over Social Security, and we've gone over three different ways of thinking about personal retirement savings. One is as a pile of money, the second is as an interest machine, and the third is as an annuity or changing your asset and your income. So that's now 5 different conceptions of retirement that we've gone over. Now there is a sixth conception. I'm going to go over 7. The sixth conception, let's call it a hybrid retirement conception. Now, what hybrid retirement has come to mean is basically a person who retires in the sense that they stop working at the 9 to 5 that they worked at for many, many years, right? So let's say you are a teacher and you stop teaching. You've worked as a teacher for 30 years, 25 years, 40 years, whatever. You stop working as a teacher and then you get a job, stocking shelves or answering questions at a local convenience store, whatever. You essentially continue to work, but at the same time, maybe you are collecting or drawing some money off of a retirement account, or you're collecting Social Security or something like this. So a hybrid retirement, basically, in my way of thinking about it here, is that you're still working. So understand, in retirement, you're going to have to pay for basic expenses, right? Mortgage, utilities, and groceries. You're going to have to pay for these basic expenses, and the question is, how are you going to do that? If you are no longer going to your day job, how are you going to pay for basic living expenses? How are you going to pay for your mortgage payment, for your utilities, for your groceries? And so, in many cases, people who don't have a pension, they don't have adequate Social Security, and they don't have personal savings, so they can't use any of the other 3 strategies, they're going to be forced with the proposition of returning to work, and they have to work somewhere. Maybe they don't work at the job that they retired from, but they're going to have to work somewhere because they're going to have to bring in income every week, every month. So that is the 6th conception. We'll call it hybrid, is when you are basically continuing to work. Maybe it's not the job that you worked at for the majority of your adult life, but you're going to have to bring in earned income somehow, and so you're going to have to continue to work. Now, the 7th conception is basically going to be a composite. Now, what I mean by composite is a little bit different from a hybrid. So, let's say that you have a strategy where you are going to incorporate, let's say maybe you have a pension, modest pension, you're going to include Social Security, maybe in addition to that you have a 401k with $500,000, and you're going to basically annuitize that. So your living expenses are going to be taken care of by some combination of employer pension, Social Security, and private savings, right? For other people, a composite's going to look very different. Maybe they work for a job where there is no employer pension. So their composite is going to be some modest Social Security benefit plus some combination of drawing income out of a retirement account, using it as an interest machine, or annuitizing a portion of it. Certain retirement pundits, Tom Hegna in particular, and I think he's well worth listening to, but Tom Hegna says, well, he's got multiple annuities. So now this is, just to give you a sneak peek, why some people think that what you need for retirement is going to be $1 million, $2 million, a lot of money. Why? Well, because if you first of all think that $1 million at 5% rate of return is $50,000 a year, then you need $2 million in order to generate 100,000. So if you need 100,000 right off the bat to cover your living expenses, you're probably going to need 2 million in your retirement account. But here's the other factor: is when you actually consider the pressures of inflation. Inflation has the ability to double prices, let's say in 18 years. At 4% inflation, at 2% inflation would take about 36 years, according to the rule of 72. And so what we're talking about here is the pressure that is experienced by retirees on a fixed income by the fact that prices increase over time. So if you're 67 and you have to have 50,000 to live on, by the time you're 87, at a reasonable rate of return, you may need $75,000 to $100,000 in order to pay for the same amount of goods, services, and that kind of thing that you had paid for at the age of 67 with $50,000. So in other words, by the time you're 87, 20 years out, prices may have gone up. In certain sectors, you may find yourself in need of more money down the road, and that's just from inflation. In addition to that, many retirees, of course, as they're aging, may experience long-term care needs. They may start to require memory care. They may start to require help in the home from assisted living or some other kind of a thing. So the point is that it is very difficult maybe to predict what your expenses are going to be. But if you are basing your retirement on the idea that you're going to live on the same amount of money for the rest of your life, you probably want to think a little bit more carefully about the effects of inflation, about the possibility that you may experience long-term care needs, that you might have health problems of some other kind, that your expenses are going to go up is very, very likely. So this is not meant to be a downer here. I know it's a very difficult conversation, but the point is the person who aims at nothing invariably hits his or her mark. If you can sort of put into place some kind of plan, it doesn't have to be perfect, but as long as it is better than what you had previously, you may end up in a better place. So now I've gone into greater detail on some of these things. I'm going to go into annuities in another video. Like I said, I've talked about 401k, IRAs, and the like of that in other videos. I'm going to explore these things at greater length, but I just wanted to sketch for you 7 different conceptions that people often have of retirement and just kind of raise some issues. And my whole point, please don't misunderstand, my whole point is simply to get the gears turning, to get you thinking about certain issues that pertain to your retirement. Feel free to leave comments below if you think I've missed something. Like I have said, and please don't miss this point either, I have indeed abstracted away. I've ignored a lot of things. I've ignored many, many things when I'm talking about some of these numbers. They're just very rough numbers, and they're designed to give you a flavor for some of the problems. So call it an impressionistic conception of retirement planning. And it's, again, just to kind of get the creative juices flowing and kind of get you thinking in certain directions. So if you found something of value in the video, please like it. Please subscribe to the channel. I'm going to try and do some other videos. And again, leave me a comment if you think I missed something, or if you'd like to hear something more or more in depth on something. I'd be happy to go into it. I hope this has been of some use to you. I appreciate your time today, and I look forward to seeing you in a future video. Thank you so much.